Hi everybody, my name is Jason McDonald. I'm a senior trading mentor at ITPM, the Institute of Trading and Portfolio Management. Today, I want to talk to you about a couple of commodities, gold and oil. So the barbarous relic has been hitting all-time highs this year, whilst oil has been stuck in a rough trading range between $70 and $90 for quite a long time. Here's a chart of gold over oil. Think of it as how many barrels of oil an ounce of gold will buy. As you can see, it's now at historically stretched levels. Now, just because it looks stretched on a chart doesn't mean necessarily that it has to revert to the mean. However, let's take a look inside and see what's been driving things. Clearly, every man and their dog has been getting into gold, whilst oil, as I said, has remained range-bound and just not really done much. Gold has had a roaring start to the year, rallying to more than $2,900 an ounce. Given market's typical attraction to round numbers, $3,000 an ounce is now the number in everyone's sights. Now, some of the key reasons underpinning this bull market in gold include as follows. Confiscation by Western governments of Russian foreign exchange reserves and Russian oligarchs' wealth after the Ukraine invasion. This changed the entire global financial picture. 2. The hangover following the COVID-era loose monetary and fiscal policies. And thirdly, the US-China trade war turning into a tech war and now a great power conflict. Because of all of these factors and others, gold has been very strong, even in the face of rising US bond yields and a strong US dollar. These would normally be market conditions that would induce gold to struggle. However, the fundamental backdrop, as we've just said, has shifted. In addition, there could be a technical catalyst behind some of the rally this year as well. So the US's threat to impose tariffs on all goods coming out of Canada and Mexico has caused fear that extra tariffs will be imposed on gold and silver imports. Such taxes would make physical settlement of futures positions more onerous. As a result, the cost of borrowing gold and silver has shot up, as has the cost of shorting precious metal exchange-traded funds listed in the US like GLD and SLV. As most experienced traders know, standing in front of a short squeeze is a challenging way to make a living. However, against that, the main concern has to be that valuation metrics for gold are getting very stretched. In the US, the ratio of gold to oil, gold to wages, or gold to real estate is approaching, if not at, historical highs. So from a contrarian perspective, I'm asking the question, what could go wrong for gold? Well, if we get a Ukrainian peace deal that sees Russian assets being returned, that could put the brakes on the gold price. If you remember, the starting gun to the current bull run was the confiscation of Russian assets. So a deal that essentially says let bygones be bygones could therefore push the gold price down. Another thing that could threaten the gold price is a meaningful cut in US government spending. Now, the DOGE has gone from being a slightly wacky Musk-Trump idea to looking like a serious proposition with real legs. A meaningful reduction of US government spending will not only reduce the supply of US treasuries, it will also put pressure on other OECD countries to get their own spending in order. This would be bullish for government bonds everywhere and bearish for gold. And actually, US treasury yields have recently been falling. And what about a sustained bull market in Chinese equities? They've already had a good run, but a continued rally in Chinese equities might start to see Chinese capital gradually rotating out of gold and into Chinese equities. The Chinese, amongst others, have been very large buyers of gold. So given that the reality of a gold price that is starting to look expensive against other commodities and against historical benchmarks, keeping an eye on what could possibly go wrong for gold at this point makes sense. So what about oil? As said earlier, Brent has traded 70 to 90 for the last 3 years. And actually, by the way, this is a range where producers make money, no one goes bust, and the global economy hums on nicely. So what could push the oil price higher? Well, whilst Trump is open to talks with Russia, he also seems to believe that further pressure on Iran will lead to a collapse of the Iranian regime. Essentially, the opposite to the policies of Biden's administration, where they were tough against Russia whilst letting Iran export oil in defiance of US sanctions. That tightening against Iran is already having an effect. The shortage of ships willing to carry Iranian oil means that Chinese refiners are rapidly running out of their preferred feedstock. This is occurring against a backdrop of low oil and energy inventories across China and the rest of the world. Now, Chinese economic growth has been slowing for a long time, for about a decade, and the current rebound in Chinese economic growth will very likely be mild relative to the extraordinary growth rates that we've seen in the past. Nonetheless, if we got a combination of falling US Treasury yields, which has already started, a falling US dollar, which is a key plank of what the Trump administration would like to achieve, and rebounding Chinese growth, none of those things is exactly bearish for oil. Oil inventories are low everywhere around the world, including in the US and China. This means that the ability to absorb either a supply shock or a demand shock is limited. Putting all of this together, it seems likely that in the coming year, demand for energy will continue to chug along nicely. It could even surprise to the upside. The Trump administration's ability to keep oil prices low will depend on its ability to encourage increases in supply either domestically or abroad, for example from Russia or Saudi Arabia. I'm not sure that the Saudis are either able or willing to increase their crude production. Now, with these trade ideas, don't forget that you don't have to put on both of them. Either one of these trades could work. So you could put them on in isolation or in combination, and if only one of them works, you could still potentially make great returns. And that could happen even if we just see a small 10% reduction in the gold price that results from some profit taking or rotation into other asset classes like equities, US bonds, or oil. So how might we express this trade thesis? Here's a chart which shows you the correlation between the gold price and an ETF, a gold ETF, listed in the US, whose ticker is GLD. The correlation, as you can see, is between 0.94 and 0.99 between GLD and the gold price going back 10 years. So essentially 1 to 1. So this trade structure is what we call a calendar put spread on the GLD, the gold ETF. So the current price of the GLD is around $269. And this structure would see you buying or going long of June 260 GLD puts. And on the flip side, you'd be shorting the April 258 GLD puts. So it's a calendar put spread, long the June 260s, short the April 258s. If the gold price or the GLD price doesn't do anything between now and the April expiry, you would collect the credit. And then, of course, that would give you the opportunity in the future to short May and then June and make it a vertical. Now, if you just take that credit for April and you remain long of the June 260s and subsequently the gold price drops by 10%, that alone gives you a 5-to-1 payout ratio. This structure would be on a 2-for-1 basis. So in other words, for every 2 contracts of the GLD 260 puts, you would short one of the April 258s. So that if you were to get a sudden drop in the gold price, you would still make good returns with this structure. And as I say, if the GLD price doesn't tail off and you take in the April credit, you'll make more than 5-to-1 times. Now here's the correlation between the oil price and something called the USO, which is the US Oil Fund. It's basically 1-to-1. It averages out over time of 0.96. The weird gap that you see in the middle of the chart is when we had the COVID situation, which at one point led to the unprecedented situation of the oil price temporarily actually going negative. But if we take that out, basically the correlation between the oil price and the US Oil Fund is 0.96, going back a long way, and so essentially 1. Here's the USO options chain, and here's the proposed trade structure. So it's another calendar spread, obviously this time with calls on the USO. So the current price of the USO is around $74. This structure would involve going long of the July 77 calls and short the April 80 calls. Again, on a 2-for-1 basis. So in other words, for every 2 July calls that you buy on the USO with a 77 strike, you'd sell one of the April 80 strike calls against that. And again, as you can see, we've got very healthy potential returns here. So if the oil price were to spike 20% or more, you'd get an approximate 4-to-1 payout ratio. And again, of course, you'd have the opportunity, having taken in the credit in April, to short the May and the June and then the July contract on the USO, hence making it a very high payout ratio. Now, the sizes that I've put in these example trade structures are based on a typical $100,000 portfolio. Of course, people with different size portfolios can adjust the sizes accordingly. Now, the beauty of these trades is that you could put either one of them on or both. Any combination of the oil price going up or the gold price coming down would be a great portfolio hedge, as both of these at the moment are contrarian positions. Lots of flexibility, lots of optionality, exactly what we want as traders. If you'd like more information about our online education and one-to-one mentoring, please visit itpm.com. And once again, thanks for watching.